Welcome to our first quarter review for the residential segment. Overall, it's a very good quarter, so we're going to touch on some of the highlights and things that have been going well and what we're seeing in the market. And as always, we have our live Q&A where we can tune in, ask any very deal-specific questions along the way. So let's get started with the market and where we're at now versus, I don't know, where we were last year, basically. But you spoke at the Best Ever Conference.
The Best Ever Conference was based in Salt Lake City. Great conference. Give or take 1,000 people showed up to it. A lot of multifamily syndicators were there that are relatively new compared to us. Really come into business the last 3 to 5 years, and a lot of them were buying and really bullish on Class A multifamily or multifamily built in the last 5 years, and where they're really seeing a buying opportunity is new construction that's not leased and needs to sell because the builder can't really continue to hold it through the lease-up period. The lease-up period on, say, a 200-unit property is going to take the better part of a year, and they just can't continue to float their construction debt while doing that. And so these guys are saying, and we're talking about garden-style new construction, not urban high-rise, more suburban. So, Gwinnett County or maybe even like Spartanburg, they presented a deal in Spartanburg, South Carolina, where we used to own. And they were delivering at about a $220,000 per unit cost, and they were able to buy these for about $180,000 per unit.
So the developer's taking a $40,000 per unit haircut?
Loss. Yes.
Ooh.
So that was the opportunity that they were seeing, and they were a lot of the groups were really, number one, they were really excited about that. Number two, the way they were underwriting it was they were buying it in place, say a 3 or 4 cap rate, and they were stabilizing around a 6, and they were projecting an exit around a 4.5, 5 cap rate. Projecting that in the next 3 years, because they all had to exit in a 3-year hold cycle. That's the business model. And they were really projecting that interest rates would be cut again, and cap rates would basically fall down to sub 5 again, which is pretty aggressive.
So even with a big discount, they still need some things to go right.
Yes.
There's not a whole ton of wiggle room in the opportunities that are out there right now for things to perform well and hit the numbers that you want to see, which is going to be mid double-digit IRR.
Right.
That's where really any real estate deal has got to be able to show, like, how am I going to get to a 15% IRR and make it work?
Right. And I mean, great guys, great groups. They really had good operations, but very aggressive projections, really based on the past 10 years, not really looking forward at kind of the current environment, looking into kind of the next cycle. We're kind of more fundamentally different than those groups, that we're looking at what is today's situation and how do we operate in today's environment. If the market does better, that's great. If the market does worse, we can at least adjust back. We're not really projecting a future growth.
Yeah. And we look at just market general overall. I mean, CoStar is really where we get a lot of information from. They have pretty good points out there. It's not perfect, but then we just compare it to what we're actually seeing in the market right now. So we look at CoStar from a market level. They're kind of showing like flatter vacancy, but it's still double-digit vacancy is what they're showing. Whether they have all the data points or not, that's what they're showing in it. We're seeing occupancy that's higher or vacancy that's lower than what they're putting out there, but they're also seeing market rents still growing.
Right. And this is, the CoStar data we pulled was really properties built prior to 1985 in the Atlanta metro market. So really trying to compare apples to apples where our properties fall. And they're seeing really flat rent or to slightly negative, say maybe negative 1%. But yeah, with vacancies really growing, they were sub 8 and now they're pushing, closer to that 12, 13% range.
But then the nicer, newer stuff is still seeing market rent growth.
Yes.
So kind of like two different stories that are happening right there in the market.
Right, exactly.
Cool. Okay, so let's go through what our portfolio did as we look at the first quarter of 2025. From a revenue standpoint, we saw revenue gains of just under 3% compared to first quarter versus the fourth quarter of 2024. And that's down from when we were looking at kind of the peak of multifamily, the 21, 22 timeframe, when we were seeing 10% plus revenue gains. Now, a 10% revenue gain is like a 20% rental rate increase. So this quarter, we saw around 7 to 8% market rate rental increases, which is higher than what the CoStar data shows, and then also kind of up there in line with what some of the nicer, like Class A higher price stuff was showing as their market rent attempts at gains. Doesn't mean you're getting it, just means what you're marketing and advertising it for.
And part of the reason why we're kind of clarifying this point of like we saw 3% revenue gains, but we saw 10% rental rate gains. The difference of those two is that we only see about a third of our units turn every year. So the 2/3 that are in place, we're seeing pretty nominal gains on those, maybe 3 to 5% on the high end. But the ones that turn, we're seeing those kind of catch up because that person's been there for 3 or 4 or 5 years. Now we get to go to market and capture the current market rate from that we've been behind.
Yeah, and they do it at all different times during the year. So it's not like it's just at January 1st you get this new rental rate and you're there. It goes throughout the whole year.
Right.
So the other thing we're starting to see is kind of creeping into the picture when we look at our financials are rental concessions. And this is something that really, this left the financial statements for a few years, and there really were no concessions that are out there. Now we're starting to see this creep in. Our concessions, although nominal for the first quarter, we're talking like $10,000 to $12,000. They were 50% above what they were the prior quarter, though. So we're starting to see concessions come into play. And that's, in our world, is essentially like, okay, you're getting $100 off your first month rent or something like that. And a few of those add up and it starts showing. So we thought it was, relevant to kind of how the market is performing that we are starting to see concessions that are coming out.
Yeah, and really we get more aggressive on concessions when we see our occupancy really drop below that 90% range, or we see our retention rates really start dropping. We start getting more aggressive on how do we keep the building occupied and keep leasing momentum going.
Yeah, so let's talk about that occupancy number. We look at our residential portfolio, and it's really in two buckets. We have our mobile home communities, which have historically, at least the ones we have right now, the pool that we have left, have had a very steady occupancy, and they've really been around 97, 98% for about 2 years now. We have not seen any dips or any wavering in that, and it's really been a flat occupancy, which has been great for that asset and performing really, really well. On the apartment side, we saw in the middle of 2024 really the loosening of the no eviction policy or the you couldn't evict someone policy for non-payment. The city of Atlanta specifically made some big rule changes around that. So we saw an occupancy drop after those policies went into effect, and now we've really been recovering from that. But it'll be about 9 months.
Right. And those are really more heavily concentrated on our one QOZ property over on the west side. On the west side of town. We sold West Side Apartments because we were experiencing this heavily there. And we have another townhome project over there as well that we are recovering from these eviction policies. So it's really, I would say, more heavily concentrated to certain neighborhoods of Atlanta, not necessarily a blanket across the whole city.
Yeah. But overall, our occupancy in the residential side on the apartments are right at 92%. So we feel like we're in good shape there. It's performing well. It came back from we dipped down to the high 80s was really our low point. And if we go way back in time, the 2020 timeframe, we had occupancy of 100%. Summer of 2020, there was nothing available. But that doesn't necessarily mean that everything was being paid.
Right, exactly. Well, so when we talk about concessions, I think advertising comes into this conversation as well. Is that historically we've looked at different advertising mechanisms, and the last 3, 4, 5 years we have not needed anything like that. And when we look back at it, or even test it out, it just really increases the amount of bad applicants we have. So it doesn't necessarily get us good applicants; it just gets us more bad applicants.
It creates a lot. It almost creates a lot more work sometimes, because we'll go through and we'll sign up with some advertising platforms and we get 100 spam applications, and it's exhausting.
Right. It's almost it's almost like a target. You're putting up a target for fraud to introduce in your system. So
we don't spend much on advertising. It's a very minimal part of our operation. And a lot of what we're getting are referrals or walk-ins still in the type of communities that we operate in, and the type of assets we have that works for us very well, and really just sticking to that. Mm-hmm. Yeah. Okay, so let's dive into our operating margins. This is a key driver, right? We want to see revenue growth, which we saw in the first quarter. And then each quarter, we want to look at how are we doing on the operating side. This quarter, our operating margin was 46%. So for us, that is strong. We have been in the 47 to 50% really for the past year and a half. That's really where we've been hitting. And what we saw happen this quarter was we were able to bring in some services that we're doing with our team. So a lot of times, and we've talked about this before, that it's hard to find vendors that can do all the functions all the time. So this quarter, one thing we were working on doing, and really over the end of 2024, is doing some of the pest control services and trapping and that kind of stuff on our own. So this quarter, we saw a little bit of a reduction of our outsourced, what we call contracted services, and we also saw a reduction of our internal manpower. So those two things that went down, wages and salaries and contracted services, a little bit lower. That's what added to our operating margin really outperforming this quarter versus past quarters.
Yeah, this is part of one of the benefits of having our assets for longer term is that we did these big renovations on them. We know the assets. We know what's going on from an operations standpoint, and our teams are mature. They know how to operate these things, and we get more efficiency out of our staff.
Yeah, just working better as a team. Mm-hmm. Well, one thing we've been using, here's this platform called Culture Index, which really kind of assesses like how people work and how you can work effectively together. That's been helpful. Using Asana, our task management process. So we feel like we have things pretty well oiled. There's always, every quarter we got to improve. We have to constantly do better because there's always this outside forces that can increase in costs or make things take longer that we have to always be ready to work through.
Yep.
So next part we want to go through is debt. Debt is a huge part of any real estate deal, or normally the largest investor in a deal. We have a bunch now where debt is not the largest, but a lot of deals you go in real estate bank is the largest investor, mm-hmm. right? So we, for the most part, have very attractive debt. We spent years locking in our long-term fixed rate debt that goes out to like 2029, 2030. A lot of those are in really good shape. We only have one loan that's coming up this year, and we're currently at 3.5%, and it renews in December. We've been out getting debt quotes on that, looking at what's available in the market, and we're seeing 5.5 to 6%. And that's typically on like a 5-year loan. Mm-hmm. We're going through agencies looking at that kind of stuff. We're not in any super rush, though. We're going to kind of we want to hold our 3.5% as long as we can on that deal. It doesn't come up until December, but we have to start looking at this stuff early in the cycle.
Yeah, and then one alternative is because we're at such a low leverage position on this asset and many of our other assets, a consideration like we did on one of our mobile home properties last year is just to pay off the debt.
Yeah.
So
yeah, we did that. Yeah, we did that last year, and it's another option we're looking at too. Mm-hmm. Because it's got to make sense from just a use of investor funds of what do we do with the cash we have at an asset going forward. So we'll assess that, and if you're in that deal, you'll get a lot more emails on our process and our thinking behind how that deal is playing out there.
Yeah, but it's pretty good to see that Fannie and Freddie are still actively lending. Their leverage ratios are much lower than we have seen historically. Normally getting to like the 75% range is pretty reasonable to get with them. We're hearing and seeing in the market, that they're lending more in the 55% range, maybe 60%. So that's really hurting, not necessarily us on this one specific deal, but it definitely hurts when we're looking to sell a deal or hurting new buyers from basically paying up for a deal.
Yeah. Yeah, and that deal specifically, I mean, we're only looking for like 15% leverage.
Right.
So that's why it's like, hey, do we actually just pay this off, or do we get a new loan? We're at 15% leverage, so
yeah,
we got a lot of options at that standpoint. That's one thing we've always wanted to be paying down debt. It just kind of gives us more options long term, and that's we've owned this deal for 12 years. Yeah. So, we've paid down a lot over the time frame, and we're in good shape there.
Yes.
So. Okay, overall the quarter, we look at, really what it comes down to is what were the distributions that were able to go out. And we had a great quarter on the residential side. We have more distributions going out this quarter than we had in any quarter of 2024. So things have been performing really well. We look at our net margins. We had just over 13% net cash over revenue. So for every dollar we generated, we were able to keep 13 cents. And that's going to lead to distributions really for all of our properties except for a handful where we're looking to sell.
Right.
So
80% of the residential properties will be distributing. 20% will not be. Those 20% we're looking to sell. Let's talk about that for a minute. What's going on in the transaction market and kind of what we're seeing.
Yeah. So the transactions have been tight. Like we just look at the the volume of transactions, whether it's our deals or anyone, we're looking at transactions that have happened. I mean, it really peaked in 2022, and there was a ton of volume and a ton of activity out there. And the middle of 2024 was one of the lowest periods of transactions that was out there. We're hoping it picks up. I mean, kind of hope isn't a great plan. It's definitely been it's been very tight. We've had a couple deals like Fairway or City View or the Grove. These are apartment deals we've owned for many years that we're looking to exit at this time, and it's been slim on how many buyers are out there, but also just transactions in general. So it's not a great time to say like, hey, well, it's not a great time if you have to sell something. It's if you can be patient, you can probably get there on something, but it's pretty slim out there.
Yeah, I mean, what we're hoping is that there's so few transactions happening. There's so few deals hitting the market. We thought maybe we'd get a premium by going out to market. And we went out to market on a couple of these deals, and the feedback was fairly soft in terms of there just wasn't that many. We thought we'd have 15, 20 bidders. There was more like 2 or 3. Yeah. And they were coming really below our marketed price. And then when really push came to shove of like negotiating, they actually just backed out. So let's just make up a number and say we were trying to get 10 million. They came in at 9 million. So we started countering, aiming to maybe land at 9.5. And by the time the countering went back and forth, they just decided they didn't want to do it anymore. Yeah. And we're like, well, is there a price anymore? Would you do it for the 9 just so we know? With like, no, not anymore. So it's been an interesting market. That I think our operating model of holding deals long term and having long-term fixed debt will put us in a position to really ride out the storm that we're seeing of kind of soft transaction volume. And yes, we will look to exit some of our properties, but it's going to take a lot longer time than we.
Yeah, we don't really need to just leave money on the table,
right?
Necessarily. So we feel like we're in a good position, in good situation to operate and keep going with things. However, we got 3 deals out there that were like, yeah, we would, we'd transact on these at the right price point and making sure like it is a good deal. I don't think we're being completely unreasonable on what we're asking for. So on those, we're going to keep operating. We're going to keep holding, and hopefully we continue to see operating margins improve and continue to do better. But it is tight out there. There's not a lot of activity happening. And with anything that's related to tariffs, so it's almost one of the main questions we get is like, how is this going to impact this or all these trickle through things? And it's pretty challenging to say like, hey, this is how it's going to play out. So this is how it's going to impact things. The only thing we can think is like, if there is actually this push to do more work in America, to use more stuff here, it's like that involves people and that involves space and real estate, and that should be helpful.
Yeah,
that's a very general statement, though. Right. That's not like, hey, this is going to have the direct impact here, because we almost don't even know what's actually going to play out. Yeah,
I mean, over the last week, tariffs have gotten really hot and cold throughout the whole week. That there's not really a projection to make yet. I think that the dust will settle on that in the next really 90 days, and we'll be able to have a better opinion on how tariffs will impact the business. But right now, it's too dynamic.
Yeah, because it's not only our business; it's all of the people that have jobs and work and are renting an apartment, all different industries, how that could play out.
Right.
Yeah. So, but overall, very strong quarter from the net operating margin standpoint. Very pleased with that. We're going to see distributions that are going out. They'll all go out on the 20th. All of our distributions always the same time. So you can look forward to that. And we'll also have our live Q&A where we'll dive into any property and go through all the specifics of how that's operating. We'll have a link if you want to register for that as well. Cool. Thanks for watching, everyone. That concludes our first quarter recap for residential. Please let us know if you got any questions on it.